Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will discuss two assets that are quite popular at the moment, and it's gold and Bitcoin. I mean, they are especially popular among the retail investors, and they are often treated as assets that are very similar to each other. So, I mean, as a store of value. The Bitcoin is sometimes, considered as a digital gold asset. I mean, we can discuss whether it's true or not true, and I think it's not exactly the true because it's quite correlated with equities and other risky assets, but it's still considered as a digital gold. But both of those assets are considered alternative assets. The question is, how you would allocate your portfolio in those two assets. How to pick whether you should invest into physical gold or into the digital gold.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
So the gold and Bitcoin itself, as individual assets, are quite popular. There are a lot of trading strategies that are built, just on those two assets. For the Bitcoin, we have quite a few in our database. For the gold, it's the same. And we decided to build a very simple strategy using the momentum that allocates between those two, and it tries, to pick which one is, the better asset at that particular moment to invest into. So how does it work? Firstly, the data. So we are using the ETFs. The ETFs are reason because they are simple to invest, they are liquid, do not face a problem with the hacking, etc., etc. So the first ETF is the ETF for the gold, which is SPDR Gold Trust, and the second ETF is the iShares Bitcoin Trust, the biggest ETF for the Bitcoin. We have a problem with the Bitcoin ETFs. The Bitcoin ETF doesn't exist very long. It started in 2024 or 5, I don't remember exactly. We need to have a proxy for the Bitcoin price before that date. We use the buy ITO, which is ProShares Bitcoin Strategy ETF, which is not buying the physical Bitcoin but buying the futures. And before that, because this ETF also started 2021, before that we are using the Bitcoin price. However, the price is from the Bitfinex exchange. We are using the hourly bars or hourly prices, and then we do the alignment. So what does it mean, the alignment? So we check every day when is the closing price of the gold, so when the actual gold ETF ends the trading, and we take the same minute and same hour from the Bitfinex exchange, and this is our price. So we are trying to align the closing and the prices of our proxy, our Bitcoin price, with the prices and especially with the trading time of the gold ETF. So the reason for that is to have really the proxy for ETF that could exist at the time, but it was not built at that time. But then in this way, we can have the two streams of the prices, one for the Bitcoin in the form of ETF, one for the gold in the form of ETF, and then we can build a trading strategy. We are starting our trading strategy in 2018. The reason for that is simple. We do not consider the price movement before 2018, before the introduction of the futures, to be especially interesting for the trading strategy, because it was before 2018 the Bitcoin was traded over the counter. There were no liquid instruments for institutional investors that they can buy. So it means it was absolutely over the counter alternative asset. This kind of situation will never again repeat in the future, especially for the Bitcoin. So all of the prices before 2018, in our opinion, are not good for any models, because those times will never again repeat. So all of the price appreciation that was before 2018, it is irrelevant for the future. Congratulations if you had a Bitcoin before 2018. I don't know, you bought it in 2014 or whatever, you made a lot of the money, but you cannot base the future models on the data that are before 2018. In our opinion, it's a really, really big mistake. We are starting in December 31st, 2018. Okay, so we have two data sets, and now the question is, how to build a trading strategy. We are trying to present you the article with a trading strategy that's useful for retail traders. So we are trying to find the balance between the strategy that trades too much and between the strategy that do not trade a lot. And if you are a retail investor, you will probably not trade every day or every minute or every hour or something like that. We are employing weekly rebalancing. and we picked the Wednesday close as a day at the day for the rebalancing. Why we picked the day Wednesday? The reason for that is that there is lowest probability that the Wednesday will be the holiday, so there will be holiday related market closure. In this way we will be able to sidestep the holiday market closure artifacts, etc., etc. Really, the midweek holidays are statistically less frequent than Monday or Friday, so that's the reason why we picked Wednesday as a day of rebalancing. This weekly frequency is the sweet spot between the signal responsiveness and implementation feasibility. So what does it mean is we have a signal. So if we rebalance on a weekly basis, we have a signal that's, fast enough, but on the other side, it's useful for retail to trade because, you just need to check the prices once a week and not every day. Then if we are building the trading strategy, we should have a benchmark which we are trying to beat, because it doesn't make sense to trade something and have a smaller performance or smaller risk adjusted returns than just buying and holding the underlying asset itself. So we have three benchmarks. So buying and holding Bitcoin itself, buying and holding the gold itself, and 50-50 split. Why 50-50 split? Because you are choosing between those two assets in our strategy. And we are using the dual momentum. So what is dual momentum? It's very often explained in the literature, so you can read the papers from Antonacci if you are interested. So the strategy uses one parameter. It's a look back period. It's measured in weeks for a momentum calculation. And we tested, the parameters from 1 to 3 up until 28 weeks. So 28 weeks is approximately half a year. Half a year momentum is long enough that, doesn't make sense to use the longer momentum in dual momentum strategy for Bitcoin and for gold, because the gold and also the Bitcoin are fast moving assets. So, we are testing the momentum parameters from 1 week up until 28 weeks. And what are the allocation rules? So we are picking between those two assets. So you are either long the IBIT or the Bitcoin ETF, or you are long the gold, or you are not long, any of those two assets, and you are flat. So you hold the cash with 0% interest rate otherwise. And how does it work? So if the performance of the IBIT over the X weeks, so over the parameter length weeks, is higher than the performance of the gold, and at the same time the performance of the IBIT is positive, you hold the IBIT, so the Bitcoin. If the gold performance is higher than the performance of the IBIT, the Bitcoin, over the X weeks, and at the same time the gold performance is positive, then you are holding the gold, and in other cases you have a flat performance. So what does it mean? If the performance of the IBIT and the gold is negative in both cases, you are holding the cash. So this structure, combines the relative momentum, so you are choosing the stronger performer, so stronger assets between the two, and the absolute momentum. So what does it mean is that you require positive returns as a threshold, and you have a flat position, that it's like a downside protection when neither assets exhibit positive momentum. So that's the reason you want to have a possibility to get out of those two assets, because there can be a time when both the assets have a negative performance. This is the simple dual momentum. However, we are also using the volatility targeting mechanism or volatility capping. Why this? So Bitcoin is extremely volatile asset. The volatility of the Bitcoin is approximately 4 times higher than the gold, and the volatility of the gold itself is high enough. So what does it mean is that we are calculating the 12-week rolling standard deviation of the both assets. We have a 20% annualized volatility cap. What does it mean? So if we pick the asset and it's a winner asset, for example, we pick the Bitcoin, and it has a 23% annualized volatility. We do not allocate all of the funds into that winning asset. We allocate only 87%, which is 20% divided by 23% of portfolio capital to the asset, and the rest is held in the cash. And then if we select, for example, the gold, and gold exhibits 15% annualized volatility, we can allocate 100% of the portfolio into the asset. And for example, then the next week, if we select the Bitcoin and it has 40% annualized volatility, we will allocate only 50% to the asset. What does it mean is that we are capping the volatility of the portfolio to 24%. We do not want to have a higher volatility of the portfolio. We want to cap the volatility of the Bitcoin itself. Yeah, we are losing some of the performance out of that. However, our risk to return ratios are improved by using the volatility targeting. Volatility targeting and volatility capping is very simple method. How you can decrease the volatility, increase the Sharpe ratio of the resultant strategy. Okay, and here are the results. So the pure momentum strategy. Here are the benchmark returns. So we can see that we have Sharpe ratio for the Bitcoin 0.73, for the gold 1.10, and 50-50 allocation is approximately 112. So this is our benchmark. We are trying to have the better risk to return ratios. If you use the momentum trading strategy with the different look-back periods, I mean, the best look-back period is approximately the 8 weeks, but there are also the other, I mean, the 6 and 12 weeks, so like 1.5 month, 2 month, and 3-month look-back period looks very nice on a weekly rebalancing. We are beating the Sharpe ratio of the benchmark, and it makes sense to build a composite strategy. So I mean, we can combine those 3 and equal weight 4, 8, and 12 week strategies together, and we will have the composite Sharpe ratio 0.47. The performance is 64%, I mean, which handily outperformed the 50-50 benchmark, gold benchmark, and even the Bitcoin benchmark. Performance with quite a high volatility, Sharpe ratio -47 and maximum drawdown -50%. This is the reason why we are interested in the volatility capping, because this drawdown, I mean, seems quite high for us. So here are the volatility capped dual momentum strategies. So once again, what we are doing is that when we are selecting the asset, we are looking at the volatility. If the volatility is higher than 20%, we are, I mean, decreasing the position size approximately to the volatility. If the asset that we picked has a 40% volatility, we are just giving the weight of 50% to that asset, not 100% for the next week. So this is volatility capping. So what does the volatility capping does? So yeah, of course, we have a lower performance, so we do not have a performance of 60%, but I mean just the 12%, but with volatility 8%, maximum drawdown -12, which is, I mean, great. These numbers are significantly more reasonable for somebody who is retail and would like to trade it. I mean, if you would like to increase the risk, yeah, you can increase the volatility cap. You do not need to cap on 20%, you can cap on 30%, but still, I mean, there makes sense to have some volatility capping process employed. Once again, the best is the 8-week look-back period, and once again, we would like to use the composite, so we are equally weighting the 4, 8, and 12-week strategies together. So the final strategy composite is built from 3 individual strategies. One is running on 4-week look-back period, another on 8-week, another at 12-week period. Each have 33% weight in the total portfolio, and we have 12% performance with the 12% drawdown, which is, I mean, very interesting from the point of view of an institutional investor. Okay, so this is, I mean, how you can build a simple dual momentum, how the dual momentum strategies work like. So for dual momentum, you need like 2 competing assets. It can be Bitcoin and gold, or it can be Bitcoin and AI stocks, or AI stocks and gold. So you need 2 competing assets, and you are taking the asset that performs the best from those 2 on some look-back period. You can use volatility capping, and you can diversify among multiple look-back periods, which I really recommend to you. So I mean, do not build your trading strategy just on one parameter. Diversify among the parameters. So I hope that you liked this video. I hope that you liked how we build the strategy. Feel free to copy it. Feel free to test it. We will have a backtest in our database. You can, I mean, join the database and review all of the other trading strategies, even for a Bitcoin, for the crypto, or I mean, for all of the other assets. We have more than 1,000 strategies backtested in our database, so you can pick whatever asset, whatever underlying, whatever instrument you would like, and you can find inspiration. And in case you like this video, please subscribe to our channel, subscribe to our social media channels, and I hope that you will join me in the next video.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.